It's 1984. Ronald Reagan is president. The S&P 500 is still around 160. Arnold's just become the Terminator. Lionel Richie just released Hello. And Warren Buffett just released his 1984 letter to Berkshire Hathaway shareholders. It's cool to see what Berkshire owns today in 1984. Its four biggest investment holdings are Geico, General Foods, Exxon, and the Washington Post. What's eye-catching to see is how well some of Berkshire's investments have done. Exxon was recently added to the portfolio, so its market value is close to what it cost. But for the others, Berkshire's up nearly 9 times on its Geico investment and over 14 times on its Washington Post investment. But it is a struggle to find good investments in 1984. Warren's highlighting that he hasn't found it this difficult to find good stock investments in over 10 years. One of the quantitative standards he looks at for investments is return on capital. A common theme in these letters is this emphasis on return on capital. You cannot evaluate an increase in earnings or book value or sales or any other economic figure without first comparing it with the capital that was needed to produce it. Okay, let's say we own a business that is generating high returns on capital. That is basically making a lot of money. What should we as owners do with that cash? There are a few options. This is a simplification, but there are 3 broad things we could do. 1, we could pay a dividend to ourselves, so distribute the cash to shareholders. 2, we could buy back some shares, so repurchase shares of the company from shareholders that want to sell out. Or we could, thirdly, reinvest it into the business. There's a few other options like paying down debt or just keeping cash on the balance sheet, but these 3 options are a good starting point. So what should we do with the cash? Well, it's simple. If you can reinvest the money back into the business and earn high returns, you should do that, obviously. If reinvesting the money back into the business will earn low returns, though, then the business should rather pay that money out as a dividend. Whether or not the company should buy back its shares really depends on how attractively valued those shares are. It's all about value. If they're particularly undervalued and the company has the cash to do so, well, then it should buy back as much of its shares as it can responsibly do so. Warren is super enthusiastic about share buybacks at the companies Berkshire's invested in. Another theme that repeats itself often in these letters is the difference between business performance and market performance. Business performance is mostly about return on capital and earnings growth. Warren keeps encouraging readers to look to business performance, not market performance, when looking at investments. Market performance refers to what the company's share price does over a period of time. It can be easy to get discouraged about an investment when its share price is falling, but we need to try to keep our focus on the actual business performance. That is, how earnings are progressing, not how the stock price is progressing. Speaking of investments, Warren talks through Berkshire's recent investment in a set of bonds to illustrate the unique way that he looks at bond investing. He looks at bonds as being like businesses, that is, equities, that can be bought at book value. So if a bond is yielding 15%, for example, he sees that as being like a business or a stock with a 15% return on unleveraged capital that can be bought at book value. The actual bonds he's referring to in this case are Washington Public Power Supply System, that's a mouthful, or WPPSS bonds. Berkshire bought them at a 16% after-tax yield, and so Warren Buffett sees these bonds as being like a business earning a 16% return on unleveraged capital, where he was able to buy that business at book value. He also makes the point that in the 1940s, investors were buying bonds yielding just 1%. In effect, they were buying a business that earned 1% on its capital and could never ever earn more than that 1% on capital. Another way of looking at it is that those 1% bonds were like a business selling at a PE of 100, where earnings couldn't grow. Similarly, in the WPPSS bonds, they are like a business selling at a PE of 6.7 times, but again, earnings can't grow. I think one of the reasons why Warren Buffett has become such an idolized figure, apart from the ton of money that he's made, is his unusual honesty. Look at how upfront he is with shareholders on his mistakes in insurance loss reserving in 1984. His problems with estimating loss cost for insurance remind him of a funny story. A man was traveling abroad when he received a call from his sister. She said, unfortunately, tragically, their father had died unexpectedly. The brother couldn't make it back home in time for the funeral, so he told his sister to take care of the funeral arrangements and send him the bill. After getting back home, he got a bill for a few $1,000s, which he quickly paid. The following month, another bill came for $15, which he also paid. Another month followed and he got the same bill. After he got another $15 bill, he started to wonder what was happening, so he called his sister to find out what was going on. "Oh," she said, "I forgot to tell you. We buried Dad in a rented suit." Last year, Berkshire bought NFM, that is Nebraska Furniture Mart, and Warren really heaped a lot of praise on them. Even more praise came this year. Nebraska Furniture Mart grew its sales by 14% this year, so it's now doing $115 million in sales. Amazingly, it's still doing all of this from one store. Warren compares NFM to Levitt's Furniture. In 1984, Levitt's is the biggest independent retailer of furniture. It has a gross margin of 44% this year, meaning for every dollar it makes in sales, it costs Levitt's 56 cents to buy that furniture before selling it to the customer for 100 cents. Well, the gross margin at NFM is a little over half of that, so around 23%. That may sound bad, but it's actually really impressive. It means NFM is offering customers furniture at much lower prices than Levitt's while still being profitable. NFM is able to do this because its operating expenses are a lot lower than Levitt's are. NFM spends 17% of its revenue on operating costs, whereas Levitt's spends 36%. Last year, Berkshire bought 90% of NFM at a valuation of $61 million. It basically paid 4 times pre-tax profit for a business growing revenue in the low to mid-teens. This already looks like a great deal. We spoke last year about how See's Candy is a great example of the beauty of pricing power. Prices have increased by 10.5% a year from 1972 to 1983. Well, not much has changed there. See's is looking to raise prices by another 7% in 1985. In 1984, newspapers are amongst the best business models one can have. Even subpar newspapers earn pre-tax margins of 30%. That's right, even being a second-rate newspaper is very profitable. The one challenge with that is that it can tempt owners to slack on editorial and product quality, since the paper will shower money regardless. Warren's aware of this temptation and trying to make sure the Buffalo Evening News keeps its standards high regardless. Bring on 1985.